Hey everyone, I'm going to tell you about somebody who read a book on technical analysis 3 times in a row and then used the information inside that book to make themselves over $5 billion. The story's pretty crazy.
Tell me more behind it. Do it.
I'm going to talk about the book itself and define exactly what technical analysis means in a second. But first, here's Cathie Wood using technical analysis to predict the future price of Tesla. And this may shock you if you haven't seen the clip already, but take a look.
This trading around, this trading range, you as a trader understand that when you build a base like that, one of two things is going to happen. It's either going to break down, and that's what a lot of the bears have been betting on, and they've been throwing everything at it, or it's going to break out. Clearly, we believe it's going to break out. And the longer the base, you say 5 years, the longer the base, the bigger the breakout.
So she was dead on. This appearance was from April 2019 when the stock was around $240, and the stock went on to rocket through $900 a share in less than 12 months after the clip was filmed.
Chart breakout on this one.
So it doesn't matter where Tesla is right now when you're watching this, but leave a comment below because it might be cool to keep track. Anyways, the point is that she was right. So did she know something, or was she guessing? And how much validity is there to this whole technical analysis thing? By the way, the book that I'm talking about is called Technical Analysis of Stock Trends by Robert Edwards and John McGee. And the person who made $5 billion is Paul Tudor Jones. Here's Mr. Jones talking about that book.
I started out working as a broker. Back then they handed you this, gave me a book on technical analysis of stock trends. He told me, read that. I read it. Go home, read it again. I read it. Go home, read it again. I read it. He goes, you're ready to trade. You're ready to open accounts.
And when I first saw that clip, I wanted to immediately go and try to figure out what he had learned and what he was talking about. So this book has been released with multiple editions over the years, and because I get overly focused on minutia and meaningless details sometimes, it was important to me to find the exact edition that Paul Tudor Jones would have read. So I went on Amazon and I tracked down a used copy of the exact same edition that I think he read, and it's from 1966.
What do you see?
So I didn't know much about technical analysis when I started reading this book, and I still really don't, but the things that I did read were pretty interesting. And I think most investors feel like analyzing stocks from a technical perspective sounds a lot like,
Why can't it start here and go like that?
Yeah, that's my school of thought.
but I think there's more to it than that. So what is technical analysis? Well, according to Edwards and McGee, technical analysis is the science of recording the history of trading activity, things like price and volume and things like that, and using that recorded history to deduce a probable future trend. So you may know that fundamental investors, which are basically investors who are focused on the value of a company relative to its price, they often shun technical analysis or dismiss it out of hand entirely. And Warren Buffett has famously said over the years that he's never met a wealthy technician.
If you're investing, I look to the business to determine whether I made a good investment. When you're just looking at the price of something, you're not investing.
Well, he's probably 100% right, but he's probably also never met Paul Tudor Jones or Stan Druckenmiller.
You're a chart guy.
Who have a combined net worth of around $10 billion or so. And by the way, I don't mean to suggest that Warren Buffett is wrong and the technicians are right or anything like that. I'm just saying I think there's potentially room for both ways of thinking. So let's look at Paul's trade.
And let me just take you to 1987. That was a big moment for you.
Well, the crash of '87 was really interesting.
So let's take a journey back to 1986. Paul Tudor Jones was running an investment firm that he founded called Tudor Investment Corp. And at the age of 32, he was the oldest person in the office. The firm had 22 employees, and they were managing approximately $125 million of other people's money. And his statistician and right-hand man was 27-year-old Peter Borish. Tudor was trading stock index futures and bonds and currencies. Performance was really good, but the firm's success turned a corner and never looked back after Paul accurately predicted that a severe market crash was imminent. That crash came on October 19th, 1987, and it's referred to as Black Monday. It was the biggest one-day drop in history for the Dow, which closed down 22.6%, and the S&P futures contracts that Paul was trading were down 29% at one point. So at the time, Tudor was using something called the Elliott wave theory to compare price movements of the market in the 1980s to the market in the 1920s leading up to the crash of 1929. It's also important to note that Tudor did not use purely technical analysis to make his forecasting or trading decisions. And in fact, he really uses a combination of charts and technicals, as well as a deep understanding of market psychology and behavior, plus ultimately really fundamental analysis in order to develop and implement his ideas. And if you read what he has to say or you listen to him talk, you'll know that. But there's no question that the core of his call in 1987 was based off of technical trading dynamics alone.
90 for 3,000. 90 for 3,000. Fill or kill.
And by the way, it goes without saying that combining all of those different investment disciplines successfully on a sustained basis is extremely challenging. But in 1987, Tudor reportedly made over $100 million in a single day on Black Monday and went on to finish that year up 125.9% after fees. Paul grew his investment fund over time, and the firm ultimately went on to manage tens of billions of dollars at its peak, and the fund is still open today. By the way, it's equally important to mention that part of Paul Tudor Jones's story has to do with the amount of time and effort that he's put into giving back to the community in various ways. In the 1980s, he decided to use money that he'd made in the markets to pay for the college education of high school students in the Bed-Stuy section of Brooklyn, and he also founded a charity called Robin Hood, which is still active today, and in 2018, Robin Hood gave over $100 million for things like healthcare and housing and K-12 education and job training. So he's a pretty busy guy. But here's what he had to say about the 1987 crash.
The crash of 87 probably never would have happened except for the market infrastructure at that point in time. There were no limits. There were no limits on any financial futures. It was just an absolute accident waiting to happen. And then they started portfolio insurance. And in 87, you could just look on any kind of historical metric and see the stock market was stupidly overvalued.
So while Paul is working on his analysis and developing these theories, one of his friendly competitors, Stan Druckenmiller, talks about the trading mistakes he made leading up to that 1987 crash. So Druckenmiller was long the stock market on Friday going into the weekend before Black Monday. But even though he was long, incredibly, he talks about how he was actually very bearish on the market for the same fundamental reasons as Paul was. But Druckenmiller talks about how he never uses valuation to time the market. He uses liquidity considerations and technical analysis for his timing. So it may not have worked perfectly on this one day, but he has a pretty amazing track record, which you can look up or refer to my other videos if you want to. In any event, in the case of 1987, a combination of forced selling from portfolio insurance, and by the way, portfolio insurance is just a fancy way of saying that Wall Street's plan to protect people from losing money was to sell stocks if stocks went down. So if that sounds illogical to you, then you understand things perfectly. But anyway, declining prices caused portfolio insurance to kick in, which created forced selling, which led to prices declining further, and so on. And so, in 1987, a combination of that forced selling and overvaluation and potentially the Federal Reserve tightening the money supply, all of those things combined to cause a severe correction where people basically panicked and sold all at once. What's maybe even more incredible about this story is that Druckenmiller happened upon Paul Tudor Jones's technical studies just after the market closed on Friday, so before he had time to sell. He says he realized he'd blown it and the market was going to crash, and here's his exact description from Druckenmiller's interview in the Market Wizards where he discusses that study. So he says, quote, "The study demonstrated the historical tendency for the market to accelerate on the downside whenever an upward sloping parabolic curve had been broken, as had recently occurred. The analysis also illustrated the extremely close correlation in the price action between the 1987 stock market and the 1929 stock market, with the implicit conclusion that we were now at the brink of collapse. I was sick to my stomach that evening. I realized I'd blown it and that the market was about to crash." So that's what Stan said about those charts and that analysis in that day. So I hope you're enjoying this information in these videos. I put a lot of time and effort into this channel, and if you haven't already, please subscribe so that you can get updates on my latest videos. There's a lot more to come in the future, and thank you. So you're also probably wondering what I personally learned from the technical analysis of Stock Trend's book. Well, the book starts out by saying that no rules are infallible, and that's definitely true. There is no secret in the book, and I think if there's one secret, it's that a book which was originally written in 1948 can be so prescient to describe patterns that still occur today in 2020. The book gives insight into the fact that humans repeat the same basic types of behavior and market participants are no different. And if you've studied how things have played out in the past, you have a chance of understanding what might happen in the future. So I haven't even finished the whole book, and I guess if I want $5 billion, I need to read it at least 3 times. So if you're watching this a few years after 2020, ask me if I made it. But anyway, here's an excerpt from the book which discusses the making of a bull market. And it could apply to a stock or an index average, but it really is pretty amazing. And I encourage you to pay really close attention to this because I don't know, I think you'll find some eerie parallels with things that have gone on recently. The book talks about how primary bull trends usually occur in 3 phases. And remember, this was written over 70 years ago. Phase 1 is the phase of accumulation, during which far-sighted investors, sensing that business, although now depressed, is due to turn, are willing to pick up all the shares offered by discouraged and distressed sellers and to raise their bids gradually as such selling diminishes in volume. Financial reports are still bad and, in fact, at their worst during this phase. The public is completely disgusted with the stock market and out of it entirely, and activity is only moderate but beginning to increase on the rallies, which are called minor advances. So I'm not going to go into as much detail on the second and third phases. Maybe I'll make a follow-up video because it gets quite lengthy, but the second and third phases are equally interesting. So phase 2 is one of steadily increasing advance and increasing activity as the improved tone of business and a rising trend in corporate profits begin to attract attention. So that's number 2. And then phase 3, in the third phase, the market boils with activity as the public flocks to the boardroom. All the financial news is good, price advances are spectacular, and frequently make the front page of daily newspapers. So anyway, very interesting. That's all. Please subscribe if you want more, and thank you so much for watching. I will see you soon.
Where you want to be is always in control, never wishing, always trading, and always, first and foremost, protecting your ass. And that's why most people lose money as individual investors or as traders, because of the fact they're not focusing on losing money. They need to focus on the money that they have at risk. How much capital is at risk in any single investment they have? If everyone spent 90% of their time on that, rather than 90% of their time on pie in the sky ideas about how much money they're going to make, then they'd be incredibly successful investors.